hosting the world's very first international online seminar for where traders from around the world will get to meet some of the senior executives of the industry and have some actual insights right from within the actual brokerage industry itself. So we're going to talk about a various range of very interesting subjects. So I'd like to welcome you all to this particular online conference. And to start off, without any further ado, I'd like to introduce you to Ilan Azbel. So I'm delighted to introduce Ilan. Ilan has been involved in financial markets for over 20 years, both in the capacity of a trader, so there's certainly something that you will all relate to there, and is now the head of a global group of companies involved in financial market analytics and research. He's very highly respected by his peers as a thought leader and innovator. So over to you, Ilan.
Can you hear me now? Can you see my screen?
Yes. Yes.
Andrew, you can see my screen? Okay, great. Hi, everyone. Andrew, thank you very much for that very kind introduction. So all the speakers in today's event will mostly be speaking about, I think, a lot of current market conditions. And so I decided, really as the keynote speaker, to kind of stay away from COVID and market volatility, which will be covered, I'm sure, in a lot of depth by all the other speakers. So instead, I'm going to speak about something else. I'm going to speak about you as a trader, right? And how your brain works when it comes to trading behavior. So before I continue, I'd like to thank a small company called Delcos Research for helping me put together the stats that I'm using in this presentation today. So we did quite a large research project. The thing we wanted to understand in our research is what are the trading characteristics or market events that affect a trader's ongoing participation in trading, right? That is, when a trader exhibits certain behaviors, right? What does it mean for that trader's long-term participation in the markets? How is the trader affected by market events and adverse trading conditions, right? So you'll find in the industry that so-called trading experts are always talking about trading psychology, giving you tips of what to do or not to do. They do this based on hearsay, possibly some limited personal experience. But what we decided to do is to get some real data and number crunch it all. And it was quite a lot of data that we number crunched. It was an extensive piece of research. We analyzed approximately 3 million transactions performed by about 12,000 traders over a period of 7 years. I'm guessing it's probably one of the most extensive pieces of market psychology research done in the currency markets to date. So let me share with you some of the findings, and hopefully you can learn something a bit about how your brain works and what you're affected by on the markets. So there's 5 major events that seem to affect your long-term participation in the markets. Right? The first one, interesting enough, is incurring an excessive amount of consecutive losing trades, right? So if you, in fact, the magic number is 7. It seems that if people incur more than 7 consecutive losing trades, it results in a 28% reduction in your trading in the long term, right? So definitely some psychological effect over there. The next one takes a little bit of explanation. We call it inconsistent position sizing. And what that means that you're trading the same lot sizes across instruments where the dollar exposure is different. So for example, you're trading 1 lot of euro and 1 lot of Dow. Both are 1 lot, but actually the movements result in different profits or losses, right? And we see this type of problem really happening if traders use EAs or robots, where the traders just set 1 position size and the robot goes and trades a whole variety of instruments. And this type of inconsistent position sizing, we have found, results in an even bigger effect, right? 42% less market participation in the long run if you're using inconsistent position sizing. The next one's quite interesting. If you're the kind of trader to hold hold losing position for an extended period of time, you're not alone. Okay, on average, losing trades are held twice as long as profitable trades. But even worse, it seems that if you're a trader that does this, you're likely to only trade half as much in the future as traders that don't hold losing positions. Right. So if you're holding losing positions, you seem to as soon as you kind of get out of them, you take a breather and you slow down your trading participation. Now, the next one is probably no surprise to anyone. It's regarding economic events. So many traders are really adversely affected by economic events such as non-farm payroll, interest rate decisions, and the like. Right? This adverse effect is mostly due to two factors. Some traders are simply unaware of the news events that are happening, right? Or they just don't understand the impact that news events have on market volatility, right? And this is the big shocking part, is that if you've been adversely affected by an economic news event, you're likely to decrease your trading participation in the market by 68%. That means you're trading almost 1/3 of what you were trading before you were adversely affected, right? Again, a kind of shock to the system, right? You're trading, suddenly non-farm payroll comes out, the market moves wildly, goes against you maybe, you're taking a step back, right? Very interesting. And finally, the fifth most influential event that can happen to you that will stop you from trading is incurring an exceptionally large loss. Okay, this decreases your long-term participation by over 84%. Right, in the market, you're trading 1/5 of the amount that you traded before you incurred that large loss, and you can understand it, right? You're trading, suddenly you lose a whole bunch of money. Then the next day you wake up and you think, okay, is this game really for me? Do I want to be involved in this? Right? Okay, so it's one thing, the experts have told us. Here we actually number crunched the big stimuli that make you stop trading. But how do we actually prevent ourselves from having these behavior changing events, right? So firstly, you need to continuously reassess your trading strategy, right? If you're incurring excessive amounts of losing trades, change something, right? It's not going to fix itself. Don't put a blinkers over your eyes. Your strategy is just not going to fix itself, right? So do something about it. Second, if you're trading different asset classes or using an EA or robot to trade, calculate your volumes carefully before you trade, right? So ensure that you're not underexposed or overexposed on any individual instrument, right? Especially if you're trading across multiple asset classes. Third, don't be scared to incur losses, right? Losing trades, they take up valuable margin and stop you from sleeping, right? Even worse, close them early and move on with your life. There's always new opportunities to take in the markets. Fourth, very important, keep your economic calendar open. Be aware of the events that could impact your trades and adjust your stop loss levels during your trades to compensate for increased volatility, right? So if you open your trade and you set a stop loss, but now non-farm payroll is coming up, don't just sit with the same stop loss, increase your stop losses, right? Increase the size or decrease your position or something to make sure you manage your risk correctly, right? And lastly, always set a stop loss, right? And it's very important that you work out your stop loss not only in pips but also in dollar value, right? You'll find that a lot of the time you underestimate your possible risk when you simply look at how many pips you may lose. So obviously I'm quite limited in terms of time. It was a very quick keynote speech that Andrew so kindly asked me to give to you today. And I want to kind of conclude with a quote I found from infamous Viktor Frankl, right, which I thought was very, very appropriate for this talk. Between stimulus and response, there is a space. In that space, is our power to choose our response. In our response lies our growth and our freedom, right? So I hope that after this quick presentation, you'll take some proactive steps to prevent yourself from experiencing these negative stimuli, right? But if you do experience them, choose your response rationally and not emotionally. Thank you, Andrew, for the opportunity.
Great pleasure, Ilan. And now, further to that, was very interesting indeed, and I hope that was very useful to most traders. Certainly, definitely a lot of information that you can certainly relate to there. So now, in terms of looking at the markets,